Okay. Good evening, class. Hope you had a wonderful day. So let's continue our class for tonight. Tonight we're going to round up on IAS 16. We have learned all the principles. Now we're going to solve questions to practice the principles that we have learned. So specifically last week, I taught you the principles around revaluation. I told you that revaluation would occur, revaluation would occur when an entity uses a revaluation model. When they use a revaluation model, then they will need to revalue their assets. Now, when they revalue their assets, the impact of that is there will be a difference between the values at the date of revaluation. So that difference can either be a revaluation surplus or a revaluation deficit. If it is a revaluation surplus, I told you that that surplus will be treated to OCI, but if there is a previous revaluation deficit on the same asset, so we're not going to take that surplus to OCI directly. We would firstly take it to P&L to net off that previous deficit. So if there are any excess surplus over that deficit that you went to net off, then you can then take that to OCI. But if that change in value, or if you have revaluation deficit, you said that revaluation deficit should go to P&L. But again, if there is a previous revaluation surplus on the same asset, then we're not going to take that deficit to P&L directly, but we're going to take it to OCI to net off that previous revaluation surplus. Is if there is any excess, that is the one we take to P&L. To explain revaluation last week, I gave you four scenarios, if you remember clearly. The most complex of all that scenario was the one that has accumulated depreciation. And the one that has that accumulated depreciation, that's scenario 4, if you have not observed, it's actually exposed us to two things that are very important in the calculation of revaluation and in adjusting for the impact. Number one is that when you're calculating revaluation, it's usually a comparison between the carrying amount of the asset and its fair value, not a comparison between the cost and fair value. It's a comparison between the carrying amount of the assets and the fair value of the asset. That's the first thing we learned in that scenario 4. The second thing is this, that whenever there is a revaluation, the accumulated depreciation on that asset till the date of revaluation will be cancelled out. It will be cancelled out whenever we have a revaluation. And if you remember the journal I showed you, we firstly adjust for the impact on the asset, that is the asset account, from taking it from where it was in the asset account, which might be at cost or at fair value, to updating it to its new value, then treating the revaluation surplus or deficits to either P&L or OCI, as the case may be, depending on what they are, and any balance that will make our journal to balance is usually the accumulated depreciation. We're going to put all that into practice today in the practice questions we are going to solve. I ended the class last week by teaching you disposal when you sell an asset. Usually, when you sell an asset, it means that you have to derecognize the asset from your books, or you have to remove the asset from your books. And when you sell, you would always have a gain or a loss on disposal. And this gain or loss on disposal is computed by comparing the carrying amount of the asset with its sales proceeds. By comparing the carrying amount with its sales proceeds, that gives us the gain or loss on disposal. And of course, I showed you that when the sales proceed is higher than the carrying amount, that's a gain. If it's the reverse, that's a loss. Then I showed you the journal, how you actually do that in the books, because when you sell, besides just calculating gain or loss on disposal, even though in most of your question, that is all the examiner will likely ask you to calculate, but you also need to know how to remove all the accounts from the books since you have sold the asset. And to do that, the first thing is to remove the asset account from your books. And I've told you severally, all through your learnings on IAS 16, that asset account is always at cost. If the company is using a cost model, and it can be at fair value if the company is using a revaluation model. Now, to remove the asset account from our books, we're going to credit the asset account, because ordinarily asset account is a debit. To remove it, we credit it, and we're going to debit disposal account. You have removed the asset account. Thereafter, you're going to remove the accumulated depreciation account from the books by debiting accumulated depreciation and crediting disposal account. Then any money you received from selling the assets, the money you received from selling the asset, you're going to debit bank, you're going to credit disposal account. When you do that, the asset is completely removed from your books. Now, there will be a balance in the disposal account. That balance in the disposal account is either a profit or a loss on disposal. You see, that disposal account is basically what we do by saying that when you sell an asset, the end result is that you will get a gain or a loss on disposal. And that's what that double entry shows, because we are transferring the asset account, the accumulated representation account, the money we received. It's like we are taking everything to disposal account, where we will ultimately calculate the gain or loss on disposal as our balancing figure. But your exam sadly asks you to do that C account, but you need to know that something like that exists, which is why I took my time to explain it to you. They will just, when they give you a question, you just simply calculate profit or loss on disposal. Just compare carrying amount with the sales proceeds. But the reality is that what you're doing when you do that is as good as you are preparing a disposal account. It's the same thing. So basically, that was what we looked at last week. Now, tonight, we're going to solve questions to round up IAS 16. So I will need you to pay maximum attention as you are going to need it. So we have like 14 questions to solve. As soon as we are done with those questions, then we're done with the class for tonight. So let's get to work immediately. Question 1. It says that an entity purchased an asset on 1st January 2006 for 10 million. The asset's useful life of 10 years. The asset has a useful life of 10 years and uses the straight line method of depreciation. On 1st January 2009, the asset's useful life is revised to add a further 3 years to it. The asset has no residual value. The depreciation charge for the year to 31st December 2009 should be, okay, let us leave those options alone. Now, what this question wants us to do is to calculate the depreciation charge for the year 2009, for 2009. So, why they are asking you to calculate for 2009 is basically because the useful life of the asset changed in 2009. The examiner wants to be sure that you know the impact of that on the calculation of depreciation. That's basically because they changed the useful life in 2009 and they want you to calculate depreciation in 2009. You will see the impact. So there's a flow here. So let's start from the beginning. The first thing is that we bought the assets on 1st January 2006, 10 million, and the useful life is 10 years. We don't have residual value. They use straight line method. You see, ordinarily, the depreciation per annum ordinarily is simply the cost, which is 10 million, divided by 10 years. That means ordinarily, our depreciation per annum is supposed to be 1 million every year. Meaning that at the end of 2006, my depreciation is 1 million. At the end of 2007, my depreciation for that year will be 1 million. At the end of 2008, my depreciation will be 1 million. So 1 million per annum. And it should be like that for the next 10 years. However, in 2009, useful life was revised. Because of that, in 2009, depreciation will change because one of the variables for calculating depreciation per annum has changed. So our depreciation per annum will not be the same anymore. It will change. So whenever there is a change in useful life or a change in residual value, it's going to affect the calculation of depreciation from that year of change going forward. It will affect the calculation of our depreciation from that year of change going forward. Please note this. These are typical exam questions. Ordinarily, depreciation per annum, simple. Straightforward. But as soon as there is a change in useful life, or there is a change in residual value, I mean, these are variables that are used in computing depreciation per annum. As soon as any of them change, they said they changed it, they revised it. That means you need to know how to calculate depreciation going forward because it will change. So if I may ask you, what is the carrying amount at the end of 2006? If I may ask you, before I move on this class, can anybody tell, sorry, again?
9 million.
Thank you very much. So, okay, now, having understood that depreciation is 1 million every year until 2009 when things changed. So that means that at the end of 2009, the way we're going to calculate our depreciation per annum going forward will be the carrying amount at that date of change, at that date where there was a change, divided by the remaining or the revised useful life. So let me get the carrying amount at the date where there was a change in useful life. And how do I get carrying amount? Is the cost of the assets, which is 10 million. I'm sure you know that this is 10 million. When I write 1000 and I put level of rounding of 3 zeros, that's 10 million. Minus accumulated depreciation, meaning the depreciation we have charged from the date we bought the assets till 1st January 2009. And how do I do that? I will do my 10 million, which is the cost of the assets, divided by 10 years, multiplied by 3 years. And this 3 years means that since we bought the asset in 2006, 1st of January, and I want to calculate my depreciation up to 1st of January 2009. So that is 6, 7, 8. I'm not going to count 9 because this is 1st of January 2009. 1st of January 2009 is the same thing as 31st December 2008. So my accumulated depreciation so far is for 3 years, 6, 7, 8. So when I put this on my calculator, I get 3 million. This is my accumulated depreciation. So 10 million minus 3 million, that gives me 7 million. I've gotten my carrying amount. Then I'll divide that by the revised useful life or the remaining useful life. Note that the original life of these assets was 10 years, as at 2006. At the beginning, where there was this change, the remaining useful life of the assets would be 7 years because the asset has used 3 years. The remaining should be 7 years. But in the question, they told us that as at this date, 1st of January 2009, they added a further 3 years to the asset. So that would be 7 years, which was remaining at 2009, plus the additional 3 years they added in 2009. Then the remaining useful life is back to 10 years. So my depreciation per annum going forward is 7 million, which is this carrying amount, over the revised or remaining useful life, which is this 10 years. When you punch your calculator with this, we get 700,000. What this question is teaching you is that whenever there is a change in useful life, whenever there is a change in residual value, in this case, there's no change in residual value, it's just a change in useful life, right? the calculation of your depreciation from that date of change will change. It will change. So it will now be the carrying amount all upon the remaining useful life. Calculating the carrying amount is not difficult. It's just cost minus accumulated depreciation. Just take note what the new useful life will be. Because as at this date, the remaining should be 7, but they have added additional 3, making 10. So our depreciation is now 700. So instead of 1 million naira per annum, as it were, but because they extended the useful life, it is now 700,000 per annum. That's the solution to this question. Is that understood?
Yes, sir.
Question 2. IAS 16 requires a revaluation surplus resulting from initial revaluation of PPE to be treated in one of the following ways. We credit to long-term provisions and add to PPE, release to income statement over the life of the assets, debited to the class of PPE that is being revalued and credited to equity. Credited to equity. Of course, the answer is C. So even though what you should know is that while you're going to debit PPE, you should credit OCI. And I'm sure you should know that when we say you credit OCI, whatever is in OCI ends up in equity. So they are not wrong when they say credit equity, because whatever is in your OCI ends up in equity. So C is the answer to this question. The next question. It says an entity has a policy of revaluing its PPE. That means that they use a revaluation model. An asset cost 15 million on 4th January 2008, has a useful life of 15 years, and is depreciated on a straight line basis to a 0 residual value. The value of the asset at 34th December 2008 was 14.5 million. At 34th December 2009, the market value of the asset was 12.5 million. The accounting entry at 34th December 2009 would be, okay, let me leave these options and just solve it. The question is asking us, what is the accounting entry at the end of 2009? So again, there's a history. It started from somewhere. They bought this asset in 2008 at the cost of 15 million. The useful life is 15 years. They use a straight line method, 0 residual value. And the value of the assets as of 2008 is 14.5 million, meaning that they revalued the assets in 2008. They also revalued it in 2009 for 12.5 million. Okay. So that means here they want us to do revaluation. And for you to do revaluation, all you just need to do is whenever there is a revaluation, we will seriously need to calculate whether we are getting a revaluation surplus or a revaluation deficit. So at the end of the year, when they revalued these assets, so the first major thing we need to do is to calculate, as at the end of 2008, are we having a revaluation surplus or deficit? And the way we do that is we compare the fair value, which in this case was 14.5 million. We compare it with the carrying amount of the asset. And that is happening at the date of revaluation. And carrying amount is cost And the cost of this asset from the question was 15 million. We're going to remove accumulated depreciation, which is 15,000. That's the cost, divided by the useful life, which they told us in the question is 15 years. Okay, since this is year one, so we have only charged depreciation for 1 year. We bought the asset in 2008, so that means depreciation for this year is 1,000. When we remove that from the costs, so our carrying amount is 14 million. So when we compare this 14 million with the fair value is higher. So that means we're going to be having a revaluation surplus or a revaluation gain of 500. They did not stop there. They said in 2009, the market value is now 12.5 million. So that means there was a revaluation also in 2009. So on 31st December 2009, we are also going to calculate a revaluation surplus or deficit by comparing the fair value, which from the question is 12.5 million. So we're going to compare this 12.5 million with the carrying amount of the asset. And the carrying amount of the asset is the cost of fair value. Since this company is using a fair value model, since they're using a revaluation model, so it's mostly be the fair value. The asset account will be at fair value. And from last year, the latest value of the asset was 14.5 million. That's in 2008. That's what will be in our asset account. So 14.5 million. Deduct the accumulated depreciation, which will be the fair value divided by the remaining useful life, which will be 14 years. Because last year, the remaining useful life was 15. So this year, it should be 14. If you punch your calculator, that will give us 1,036,000. When you take that away from 14.5, our carrying amount becomes 13,464. When you compare this with fair value, the fair value is lower. That means we are having a deficit. We'll be having a revaluation deficit of 964. And that's all for this question. Now, how do we do the accounting entry? Now, the journal entry, when you want to do the journal entry, for this year, the first thing I sorted was the depreciation for the year. This depreciation for this current year. You debit P&L, you credit accumulated depreciation. Then I put my narration, being depreciation charged for the year. Secondly, I dealt with my revaluation. Now, for my revaluation, the first thing I would really want us to always address is the asset account. When you address the asset account properly, the order is just the revaluation. That will be very straightforward. So the asset accounts, how do we adjust it? At the beginning of this year, from this workings year, the value in my asset account was 12,500, which is the fair value of the assets. That's what will be in your asset account. But remember, no, it's not 12,500. At the beginning of the period, it was 14,500 from last year. This 14.5 from last year. That's what become opening this year, okay? So at the beginning of this year, what was in our asset account was 14.5. But as a result of revaluation, it is now 12.5. So what we want our asset account to show is 12.5 now. So we will need to update this 14.5. We will need to change this 14.5 to 12.5. And in accounting, we pass debit and credit. So there's a difference of 2,000. So we will need to reduce the value of our asset from 14.5 to 12.5. And when you want to reduce your assets, you credit the asset. And that is why our assets is having a credit of 2,000. That's the first thing you must always be able to adjust very well. As soon as you have done that, the next thing is just to take care of this revaluation. When you have dealt with your asset account, the next thing is just evaluation. And since we are having a revaluation deficit, you see, ordinarily you should go to P&L. Deficit goes to P&L. But in this question, there was a surplus in the previous year. That means this 964 will firstly go to OCI to net off this surplus. That means out of these 964, we are going to take 500 to OCI. We're going to debit OCI. And that is why I have this revaluation surplus to OCI. So instead of putting evaluation surplus, I would like to put it as OCI. I will debit OCI. So when I take 500 and I take it off, out of these 964, there will still be an excess of 464, which is an excess deficit. Then that excess can then go to POL. That excess can go to POL. So I'll take that to POL. If I didn't write this on there, this is the solution. If this was not there, you will see that my debit for this and this is not balancing. There is 2,000 here. There is 964 here. You see the difference. What will make this debit and credit balance for this evaluation will always be an amount that will equal the accumulated depreciation, which is this accumulated depreciation. It will always equal it, which is 1036. By debiting it, it means you are canceling it out. It means it will be cancelled out. And that is why we told you that whenever you revalue an asset, the accumulated depreciation on the asset to date will be cancelled out. I mean, it's like a start over for the asset. That's the principle. And that's the end for this question. Is that understood?
Sir.
Hello, sir.
Yeah? I'm with you, please.
Hello, sir.
Yes, Jamie, go ahead, please.
Hello, can you hear me?
Yes, I can hear you. Jamie, go ahead.
Okay, there is something that is something. Yeah, something is somehow confusing me here. Having revaluation surplus and revaluation deficit. I'm talking about that journal entry. on the same side. I need more explanation on that, sir.
Which one again?
The revaluation surplus of 500 and that revaluation deficit of 464. Why having the two of them on the same side? Though I agree that the two of them must, what we did here is that plus accumulated depreciation, it cancel out the 2,000 in the asset account. But I'm just somehow confused how we have the 500 and 464 on the same side of the journal. One is deficit and one is a surplus.
I've explained it now. I explained it. Can you remember what I said about it? I actually said something about it.
Yeah, you said that the 500 is coming from OCI account, other comprehensive income account.
No, that's not what I said. You are not listening. But I will repeat it again.
Okay.
So this deficit of 964, ordinarily it should go to P&L as a debit. But the principle is that when there is a previous revaluation surplus, that deficit needs to net off that surplus first. It has to net off that surplus first. So this 964, out of this 964, 500 will net off the surplus. So that means we are going to take 500 to OCI. And the reason why it's a debit is because ordinarily evaluation surplus is a credit. It's a credit balance, is an income. To net it off, we debit. That's why we are debiting 500. So out of these 964 deficits, 500 needs to net off that surplus first. So remaining 464, that is 964 minus 500, remaining 464. Then that 464 can then go to P&L normally. And that's why this is coming here. So, Jamie, did I answer your question? Okay. You have typed. Thank you. Okay. Okay. Yeah. Joseph, you can go ahead, please.
So these questions we are solving, where can we get it in our material? Because I try to go through my material. I know there are questions there, but not exactly as these ones you are attending to.
Go to I'm sharing the same material as you have in your notes. So it's definitely there. It's the same material I shared with you that I'm also using to teach you. So I thought most of you will even open the material and be looking at it as I'm solving and be jotting.
Check page 62. Page 62.
Oh, okay. Okay, thank you.
Any other question? If you don't understand this, better you talk now, because we'll see a lot of something like a lot like this as we move forward anyway. So you are still going to understand it, but it's better you understand it now. Okay, let's go to the third question. Now it's question 4. Now this question says that on 1st of March 2000, UCACO acquired a machine from PlantCo under the following terms. So they give us all this information. We're now told that in addition to the above information, UCACO was granted a trade discount of 10% on the initial list price of the machine and a settlement discount of 5% if payment was received within 1 month of purchase. UCACO paid for the machine on 25th March 2000, required calculate the machine cost for the year ended 28 February 2001. Okay, so this one is taking us back to initial measurements. Interesting. Initial measurements, where we learned that an asset is initially measured at costs, that we learn the purchase price, import duties, directly attributable costs. So let's see if we still remember that. So they gave us all this information. So let's pick them one by one. And let's see which one we are going to capitalize and which one we will not capitalize. So the first item here is listed price of the machine, which is 82,000. So this is the purchase price of the machine. That's the list price, how much we bought it. Of course, we'll capitalize this. Then the next one is import duty. Of course, we'll capitalize import duty as well. Then we have delivery fees. Cost of delivering the assets. It will be capitalized. Then we have installation costs. Yes, it will be capitalized. Then we have pre-production testing costs. Are we going to capitalize this one?
Yeah. We'll capitalize it. Testing cost.
No.
Okay. Somebody said yes and somebody said no. Okay, so that means we don't have a consensus yet. So the person that said yes, why did you say we'll capitalize testing cost? But if you said we'll capitalize, now we're asking why are we capitalizing?
No, sir.
Yes, I'm with
Can you
you.
hear me? Okay. Testing cost is part of the attributable cost. It is a cost that we incur to test the condition of the asset before we start using it. So it's part of the cost that must have been incurred before the asset is readily in the present condition as desired by the management.
Yeah, that's reasonable.
Okay,
Oliver.
sir, in addition to what he just said, the only thing
Yes.
that can make us not to capitalize the entire 4,900 is a situation whereby when we test run the machine and we get some sample, we make sales of those samples. Whatever we realize from the sample will now be deducted from this 4,900. That is the only thing that can make us not to capitalize the entire 4,900. Based on what you explained to us last time.
That's brilliant. That's brilliant. Okay. Oliver.
Yeah, I think I have a different opinion to that. If we said testing cost, the cost of testing the machine, maybe after installation and everything, okay, that is by the side. But like you explained, pre-production testing cost, you cannot capitalize the entire cost. It has to be matched against the revenue realized from them, written off through P&L. So that's my stand.
Okay, so your stand is that this 4,900 should be expensed. It should not be capitalized.
Yes. Should not be capitalized. Yeah.
Okay, so the guys that said it should be guys are actually right. You're correct. And for two reasons. Number one, it's specifically stated in the standard, specifically stated that pre-production testing cost is a directly attributable cost. That's why they call it pre-production, meaning the standard explained this as the cost you need to incur to test an asset before you start using it. Okay, so if you incur cost before you start using an asset to test whether it's working properly. You say you should capitalize it, right? So like Jamil rightly explained, that if you now make money or proceeds from selling those samples, the standard says don't recognize those proceeds from that samples. Don't go and put it as income yet, because the asset is not ready. Yeah, it's still testing, so it's not ready for you. So don't put that kind of income in P&L, but rather use it to reduce the testing cost. So whatever is remaining, capitalize it. So you are not expensing anything related to testing costs. It is all capitalized, and we explain all these 2 classes ago. Okay, so good contributions from both sides. Keep that up. So these will be capitalized. Then finally, purchase of 5 years maintenance contract. Maintenance would be expensed. It will not be capitalized. But since this 7,000 is for 5 years, it means that this 7,000 will be spread over 5 years. We are not going to recognize all the 7,000 in year 1 alone. We are going to spread it over 5 years. So 7,000 divided by 5 is what we are going to recognize as maintenance in P or L every year. Every year. So this will not be capitalized. Now, they told us that they gave us a trade discount of 10% on the initial listed price and a settlement discount of 5% was received within 1 month if payment is received within 1 month. And as you can see, this guy actually paid within 1 month. So he will get this 5% because he paid in March. And he bought the assets in March. So he will get this discount. So what's the impact of this? Based on what I taught you before now, this trade discount is the discount you will get immediately. So we're going to deduct this from the cost of our assets. So 10% on the listed price is 8,200. This will be deducted. But you see these settlement discounts, this will not be impacted on the cost of the assets. We will not treat it at all. You are going to ignore it. Sometimes they can call it early settlement discount or cash discount. Whatever name they call it, ignore. Ignore it. Settlement discount will be ignored. So, and that's the solution to this question. As you can see, the trade discount is the only item that we removed, 10% of 82,000. So when you cumulate everything, it gives you 91,750. This 5% will be ignored. Any questions? Okay, if you don't have any question, let me ask you a question very quickly. Now, this 5% that you received as discount, this 5% that we received as discount that we are ignoring. Okay, Victoria was asking a question, why, sir? I'm not sure what you meant by why, sir. So you have to be specific. Which of them is it? I don't understand. So while you're expressing your question, this 5% that I said we are going to ignore in determining the cost of the assets. So then how do we then treat it? If you won't consider it to reduce the cost, how do you treat it?
Treat it as an income.
It's an
Thank you
income,
very
other
much.
income, yeah.
Thank you very much. Thank you very much. You will treat it as an income, and we'll call that discount received. discount. Thank you very much. Okay. Let's go to the next question. We have construction of Amsco's new store began on 1st April 2001. The following costs were incurred on the construction. You have the cost of land, all of this. We're now told that the store was completed on 1st January 2002 and brought into use following its opening on 1st April 2002. AM took out a 25 million loan on 1st April 2001 to aid construction of the new store, which meets the definition of a qualifying assets per IAS 23. The loan carried an interest rate of 8% per annum and is repayable on 1st April 2004. Required. Calculate the amount to be included as PPE in respect of the new store and describe the impacts that the above information would have on the statement of profit or loss, if any, for the year ended at 1st March 2002. Okay, similar to the first question, to the last question we solved, but now they said we should also describe the impact of the above information in P&L, meaning that the items we will not capitalize, that means it will go to P&L. So they want us to show that P&L as well. Okay. So similar questions. So let's pick it one by one. The first one, the cost of the land that will be capitalized.
Yes.
What about architect fees?
Yes.
What about site preparation cost?
Yes.
Capitalize.
What about material cost?
Yes.
Capitalize.
Labor cost?
Yes.
Capitalize.
Capitalize.
Legal fees?
Capitalize.
Capitalize.
General overhead?
Ignore.
Correct. That's correct. Perfect. Perfect. Now, this additional information, they said the store was completed on 4th January 2002. Okay, when did they start construction? April.
2001, yeah.
That means it took how long? That's how many
It
months?
took 9 months.
9
9
months.
months.
But it was brought into use in April. Just for knowledge sake, any cost that is incurred between January 2001 and April, should that be capitalized or expensed?
To be capitalized.
It's expense.
It
should be capitalized, sir.
It should be capitalized. The loan should be capitalized. The interest of the loan should be capitalized.
The reason is that the assets had not been put to use.
No. Hello, sir.
It's available for use.
Hello, sir.
Yes.
Any cost from 1st of January onward should never be capitalized because the construction have been completed, physically completed, according to this question. So any other cost shall be expensed.
Okay, that's actually correct. That's the correct position of the standard, because this is where the asset is ready for use. So it's a different thing whether you start using it. Some people would complete an asset and they will not use it until after 2-3 years. It's ready. You are not the one that did not just use it. That's one. So Latif, you are correct. But the second thing is this, if I may ask you, depreciation on these assets, when will it start? Will it start from 1st January or from 1st April?
As soon as the asset is ready for use, which is 1st of January,
1st
then
January.
depreciation commences.
Yeah, that's correct.
1st January, yeah.
1st of January, that's correct. Okay, But now the question is not even looking at all of that. What the question is looking at is that this company took a loan when they started construction in April to aid construction of the new store. And this new store meets the definition of assets in IAS 23. So the interest rate is 18%, and they're supposed to repay the loan in April 2004. What this one is talking about is that borrowing cost I told you that when we borrow money to construct an asset, the interest we pay during the construction period or process, the interest we pay on that money will be capitalized, right? And we're going to capitalize that interest only during the period of construction, meaning after construction is complete, whatever interest we are still paying, that one will be expensed. It's only the interest we pay during the period of construction that we're going to capitalize, okay? And this is only applicable if this money we borrowed was used for construction. If we do not use this money for construction, we will not capitalize the interest at all, any of the interest. It is only the money we borrowed that we use for construction of an asset that we capitalize the interest we pay on them. So in this case now, since the borrowing cost, this 8% is 8% per annum, right? And we borrowed 25,000. And the construction period was just 9 months. So the portion we're going to capitalize is just 9/12, which is 1/5. And that is the interest we capitalize. So every other one you mentioned is correct. And you see, in the statement of profit or loss, in your SOPL, what will go there is, number one, that general overhead that we did not capitalize, this 940, we'll go to the statement of profits or loss. Number two is that borrowing costs, that period where the asset was already ready, which is 8% times 25,000 times the remaining 3 months. Okay, since 9 months was the period of construction, that the remaining 3 months of the year, whatever interest we are still paying at that period will be expensed. Who can tell me what's the answer here? You guys don't, you are not with your calculator?
Hold on, wait, we are calculating it, please.
7,190.
Or where?
500,000.
Yeah, that's 500,000. Yeah, thank you. Okay. Let's go to the next question. It says on 1st of March 2002, UCACO purchased an upgrade package from PlantCo at a cost of 18,000 for the machine it originally purchased in 2000. The upgrade work took a total of 2 days, where new components were added to the machine. UCA agreed to purchase the upgrade package as the new component will lead to a reduction in production time per unit of 15%. This will enable UCA to increase production without the need to purchase a new machine. Required. Explain whether the additional expenditure should be capitalized as part of PPE or expensed to the statement of profit or loss for the year ended 28 February 2003. Okay. So UCA purchased an upgrade package of 18,000 for the assets it purchased in 2000. So that means he has an asset before, he is now buying an upgrade on that asset. So that's like a subsequent cost. And I told you that subsequent costs can be capitalized if it meets the recognition criteria that it must have future economic benefits and it must have a cost that can be measured reliably. And I told you that meeting that criteria, especially from the standpoint of future economic benefit, it means that that cost itself must generate its own benefits, meaning it must improve the productivity of the asset or it must improve the useful life of the asset. And I told you the question will always tell you if that additional cost is doing that or not. And this question was very clear. He said, this upgrade package will lead to a reduction in production time per unit of 15%, which will enable UCA to increase production. So this cost is generating future economic benefits because it's increasing production, it's reducing production time, and thereby increasing production. So this 18,000 should be capitalized. Now, note, this question asks us to explain. And your explanation is just how I've explained to you. They didn't ask you to calculate anything. It's just explain. So, and look at the way I did my explanation. I give them the recognition criteria and I explain further that this means that the subsequent cost must improve the productivity. It must increase the useful life. So, and I said from the question, the additional cost will lead to a reduction in production time, hence it meets the recognition criteria. So it should be capitalized. Very reasonable question. Let's go to the next question. Okay, we are moving. It says a machine was purchased on April 2000 for 120. It was estimated that the asset had a residual value of 20, a useful life of 10 years. On April 2002, the residual value was reassessed to 15. The remaining useful life was considered to be only 5. How would the machine be accounted for? No. Okay, so this is similar to a question we have solved before. It's good it's coming again. So, I mean, this is an opportunity to understand it again. And what I told you today, not so long ago, is that whenever there is a change in useful life or there is a change in residual value, the only impact it will have is that our depreciation from that year going forward will change. It will not be the depreciation we're using before that we'll continue to use. It will change as a result of that change in useful life or change in residual value. And in this question, the two happened at the same time. There was a change in useful life, there was a change in residual value. So let's see how it's going to impact. What we know for sure is that the change happened at the beginning of 2002, April 2002. That means from that date, from that year going forward, depreciation will change. Firstly, in the first year, that is 31st March 2001 and 31st March 2002, depreciation will be the same thing because it's just our depreciable amount, which is the costs, 120, minus residual value, which is 20, divided by the useful life, which is 10 years. When you punch your calculator, that will give you 10,000 per annum. So in 2001, the depreciation for that year will be 10,000. In the next year, which is 31st March 2002, the depreciation will still be 10,000. Okay. And of course, since you have charged 10,000 year one, 10,000 year two, that means at the end of year two, our carrying amount is now 100,000 because costs minus accumulated depreciation, 100,000. Now, the next day, that was when these changes happened. When they change the residual value, they change the useful life. So from that date going forward, at the end of the year, depreciation calculation will change. In fact, if I want to express it very well for you here, The depreciation per annum going forward will be the carrying amount minus the revised residual value all upon the revised useful life. So the carrying amount is 100,000. The revised residual value is 15,000 from the question. So it is now 15,000. And the revised useful life is now 5 years from the question. The total is 5 years. It's only 5 years. When you punch your calculator, that will give us 17,000 per annum. That means from the end of this year going forward, our depreciation will now be 17,000 naira per annum going forward. 17,000 naira per annum, 17,000 naira per annum, 17,000 naira per annum going forward. That is what it will be. So in 2003, 17,000 per annum, 2004, 17,000, 2005, till the end of the life of the asset, 17,000, 17,000. Except if after like some years again, they change useful life or they change residual value again, then depreciation will change again. And it's just the same formula that you are going to apply. So if I want to calculate the carrying amount at the end of this year, it will be the cost, which is 120,000, minus the accumulated depreciation, which is 37,000. That is the 20,000 in the first 2 years and 17,000 in the third year. So 37. Another way of calculating it is the carrying amount at the end of year 2 minus 17,000. It will give you this same 83,000. But this is just a better way of doing it, since this is how you calculate carrying amount. Okay, but you can also do carrying amount at the beginning minus depreciation for the year. It will give you the same thing. And that's that. So, and they also prepare some statements here, the depreciation and the carrying amount. So these are very straightforward. Is that understood? Okay. Next question. Question 8. A company purchased the property with an overall cost of 100 million on 1st April 2001. The separate components of the property are made up as follows. Land and building, 65,000. Useful life, 50 years. Fixtures and fittings, 24,000. Useful life, 10 years. Lift, 11,000. Useful life, 20 years. Required. Calculate the annual depreciation charge for the property for the year ended 31st March 2002. Okay. Now, you see, this type of question, they give us a property with an overall cost of 100 million. Then I went further to break down that cost. That this property, it has components. It has different components. Land and building, fixtures and fittings, lift, and each component have their own useful life. This is what we call componentization in IAS 16, componentization, where you have an asset that have different components and each component has its own useful life. And the principle there is that depreciation must be calculated separately for each component. Again, the principle there is that depreciation must be calculated separately for each component. And that's what we're going to do here. So the annual depreciation, first for the building, I'm excluding land. That's why I have 45,000. So this 45,000 is 65 minus 20. We don't depreciate land. So we have 45,000. We don't depreciate land. 45,000 divided by 50 years. That gives me 900. Fixtures and fittings, which is 24,000 divided by 10 years. That's 24. Lift, 11,000 divided by 20 years. That is 550. So these are my depreciation on this property. Depreciating it separate. That's the end of this question. Any observation? Any questions? Okay, I have a question to ask you. I said here that I did not include land because land is not depreciated. It's not a depreciable asset. Why? Who can tell me why? Why is land not a depreciable asset?
Because it has infinite number of lives.
And not only that, it appreciates in nature. It doesn't depreciate in nature. As long as there's economic activities going around that place. So naturally it appreciates.
Okay, I was hoping to hear somebody say that so that I will quickly tell you that don't say that again. Don't say that again. It's not right. The first person that said because it has an indefinite or unlimited useful life, that's the correct position. That is why we do not depreciate land. Not because it appreciates in value. I've taught you very well what depreciation is all about. I've taught you that depreciation is not to account for reduction or increase in the value of an asset. So whether an asset depreciates, whether an asset increases in value or appreciates, it doesn't mean we don't depreciate it. Land I said land, building itself, it appreciates seriously in value. Cars these days, they appreciate in value, especially in Nigeria right now. Doesn't mean we won't depreciate. So depreciation is not to account for appreciation or reduction in value. Depreciation is just allocation of costs. That is not about what the value of an asset. It's about what portion are we accruing for? What portion have we used this year? Expense it. That's the old story around depreciation. Okay, so I've already taught you that very well before now. So please, the reason we don't depreciate land is because it has an unlimited useful life. Okay, I think we are clear on that. Question 9. A company purchased a building on 1st April 2001 for 100,000. The asset had a useful life at that date of 40 years. On 1st April 2003, the company revalued the building to its fair value of 120. Required: calculate the revaluation gain and prepare the journal entry to account for the revaluation. Calculate the revaluation gain and account and prepare journal entry. Okay, so how do we get revaluation gain? I've taught you that it's just by comparing the carrying amount with its fair value, and you do that at the date of revaluation. And in this question, they revalued these assets on 1st of April 2003. So I'm going to calculate my revaluation gain on 1st of April 2003 by comparing the carrying amount of these assets, which is calculated as the costs of 100,000. Let me check it. Yes, cost is 100,000 minus accumulated depreciation, which is depreciation from the date of acquisition to the date of revaluation. So the date of acquisition in 2001, that was when we bought the assets. The date of evaluation is April 2003. So that's how many years interval? 2, 3. That's 2 years. So that means we are going to get the accumulated depreciation of 2 years. So which is costs divided by the useful life, which is 100/40, multiplied by 2 years. That gives me 5,000. So when I take away 5,000 from 100,000, that gets me to my carrying amount of 95,000. So this 95,000, I will compare it with the fair value of the assets, because when they revalue the assets, it's now 120. So 120 compared to the book value, 120 is higher. So it's going to result in a surplus of 25, which I put in my books as evaluation surplus. So now the journal entries. So in your mind, I quickly wanted to take care of the asset accounts. We said we are going to debit 20. You can tell me, why are we debiting 20 to asset accounts here? Can anyone find?
Because the cost of the asset has increased. Because the fair value now is now 120, from 100 to 120.
God bless you. God bless you.
Amen.
So in our account, in our asset account, it was 100,000 before. Now it is 120. So we need to take up our asset from 100 to 120. And that's an increase by 20. That's why we are debiting 20. You see, the mistake you would make is to think that we are going to increase our asset by 25. That what was in your asset account is 95. No, I've already told you that what your asset account carries is not the carrying amount. This carrying amount is just done in the fixed asset schedule. Is cost that is in your asset account. Cost or fair value. That's what you find in your asset account. This depreciation itself is another account on its own. So when we want to let our asset account show the new value, it's for you to compare it with the old value, which is cost. So our asset account will increase by 20,000. So we debit it. When you have taken care of that, then you can then deal with the surplus. Surplus goes to OCI. So this evaluation surplus, I'm taking it to OCI straight on. So it's an income, so we credit. So it's like we're having 25 on the credits and 20 on the debits. There's a difference of 5. And like I've taught you in the last question, this 5 will exactly be equal to the accumulated depreciation. And by debiting it means you are canceling it out. We will cancel it out. So anytime we revalue an asset, the accumulated depreciation till the date of evaluation is cancelled out. And that's why accumulated depreciation is debited. So the narration is being revaluation of building. Any question?
Sir, please, I have a question.
Please ask.
Okay, the question is there was a question you actually solved that you said when an asset is revalued, the depreciation is always like cancelled. Is this what you mean by that?
Yes.
Okay, thank you. Thank you, sir.
Yeah. Any question?
Just for the sake of clarity,
Okay.
when an asset is revalued, there are 3 things that could play it out. One is that it may affect the cost of the building. It will affect the accumulated depreciation. And if that valuation wasn't the first one, it will also affect the OCI, depending on whether that valuation brings an increase or a decrease in the value. Is that correct?
That's correct.
Thank
That's
you.
absolutely correct. Okay, if I may ask you, even though they didn't ask us to do that in this question, now this is the beginning of the third year. Okay, so at the end of this third year, which will be 31st March 2000 and if the beginning is 2003 April, that means the end will be 2004 March. What would be my deposition for that year? What would be the deposition?
The estimated useful life now will be 38 years, no longer 40. And the value of the asset is 120. So with that, we can find the value of the position.
Thank you very much. That is 120
120
divided
divided
by.
by 38.
Thank you very much. That's absolutely correct. That's absolutely correct. Okay, I just wanted to be sure. So can you press your calculator to give me your answer? What will be the answer?
So 3,000, 3,000,
158.
158, 3,158 approximately. Yeah.
Okay, so how will I get my carrying amount for that year?
The carrying amount will now be the cost minus the depreciation. The valued, what's called the fair value minus depreciation.
With the fair value.
Yeah.
That's, we call it subsequent accumulated depreciation. So what's the fair value?
The fair value is 120.
What's the subsequent depreciation?
3,158.
Okay, good. So ordinarily, when we are doing our carrying amount, is cost minus accumulated depreciation. But in this case, since we have revalued and we have cancelled out the previous depreciations, so it's going to be the new value of the asset minus the new depreciation. So this old depreciation has been cancelled out. Here. So it's just this new value minus the new depreciation. That's why we call it subsequent. So what does that give us? What does that give us? Anybody?
It's 116,843. 842 rather. 116,842.
Okay, so that's the end of this question. That's the end of this question. Let's solve another one. I said the carrying amount of Zenco's property at the end of the year amounted to 108,000. They said the cost of value is 125. The accumulated depreciation is 17. And I said on this date, the property was revalued and was deemed to have a fair value of 95. The balance on the revaluation surplus relating to a previous revaluation gain for this property was 10,000 required. Calculate the revaluation loss and prepare the journal entry to account for the revaluation. Okay, this is a very straightforward question. They want us to calculate our revaluation loss. And our evaluation loss or deficits or surplus is the difference between the carrying amount and fair value. And that's what this question wants to teach us, because they give us the carrying amount of the assets, and on the same day, they give you the costs. So they want to see which one you're going to use. Always use the carrying amount, which they have already given us as 180. Compare that with the fair value, which they give us as 95. So since the fair value is lower in this case, so we are having a deficit of 13. That's the first part. And they want us to pass a journal. First, I will take care of my assets first. And I'm crediting 30. So again, may I ask, why am I crediting 30? Why are we crediting 30 here?
The initial value of the asset, the cost of the asset is 125, and now the fair value is 95, or difference of 30,000.
Thank you very much. It's the same thing, the same principle I've
Take care of
mentioned
the
here.
accumulated depreciation.
What did you say?
Because we have to take care of the accumulated depreciation, we have to write it off.
No, that's not why. That is not why this one is 30. That is not why. That's another thing entirely. So the reason why this is 30 is because our asset account was 125. What was in our asset account is 125. What we wanted to show now is 95. So we need to bring it down to by 30. And that's why we are crediting 30. That's why. And that's what he said. Then secondly, we need to deal with these deficits. Ordinarily, we should just take this deficit to POL. Yeah.
Previous gain.
But there was a previous gain. Because there was a previous gain, out of this 13,000, we are going to take 10,000 to that, to OCI, evaluation surplus. Take it to OCI. So the remaining 3,000, that is 13 minus 10, can then go to POL. Okay. So you will see that on my debit now, I have 13. On the credit, I have 30. There's a balance of 17 to make it balance. And I told you that that will always be the same as our accumulated depreciation. And if you look at it, it was truly 17,000. Then everything balances. Everything balances. And this is what we are talking about. You can ask questions now, please. Anywhere that you don't understand. Okay. Next question. A company revalued its property on 1st April 2001 to 20 million, 8 million of which is related to land. Hold on, why did they separate land here? Why do you think they might have given us the value of land separately? Or
Because of um, land is not depreciable, so that
thank you.
we don't depreciate it.
Yeah, thank you very much. That's correct. Okay, let's be done. That's why they separated it, nothing more. Then I said the property originally cost 10 million, 2 million of which related to land. The same reason, so that you will not depreciate it. And they said that this property cost 10 million. That's 10 years ago, which means that we bought land or this property 10 years ago. Okay, we bought it 10 years ago. That's what this simply means. So the original useful life of the asset is 40 years. So it's still unchanged. And the company's policy is to make a transfer to retained earnings in respect of excess depreciation. Prepare necessary journal entries at the end of the year. Okay. So the major thing here is that there was a revaluation on these dates. And whenever there is a revaluation, we must compute revaluation loss or revaluation gain. We must. So let's do that. That's the first thing we do. So revaluation deficits or surplus at these dates. which is 1st April 2001. What we are majorly doing is we are comparing the carrying amount of the assets with the fair value. And the carrying amount of the assets is simply the costs minus accumulated depreciation. So the cost of the assets from the question is 10 million. From the question, the cost is 10 million. The accumulated depreciation is going to be 10 minus 2, which is 8. This 2 is the cost of the land. We need to exclude it because we don't depreciate land. So we are left with 8 divided by 40 years. 40 years because that's the useful life of the asset, multiplied by 10 years. That's because we bought the asset 10 years ago. So we will have child depreciation for 10 years. If you do your maths, that brings the accumulated depreciation to 2 million. When you take away this 2 million from this 10 million, my carrying amount becomes 8 million. Then I will compare that with the fair value of the property, which is 20 million. The same thing. So one of my students was confused. Why are we comparing this one with 20 million? Are we not going to remove the cost of the land? That this should be 12 million. Didn't we remove the cost of the land here? So why are we not removing the cost of the land? Why is this not 12 million? Okay. Can anyone answer the student? Or do you feel the same way too?
Yeah, it should be 12. It should be 12 million.
Should be 12, right?
It should be 12 million, yes. Because
Okay.
we were told that 20 million is the worth of the land and the building. And the worth of the land is 8 million. So the value of the property should be 12 million, not 20.
Okay. Okay. So now, let me explain it to you again. So thank God I brought that up. If not, you would I will just explain and you will not remember to ask. So it should be 20 million, not 12 million. Look at it. The only reason I removed the cost of the land is just in my calculation of depreciation. You will see that the cost, this 10 million is the cost of the land and building. This depreciation, we don't depreciate land out of this
Okay.
cost. So this is the depreciation of the building. This 8 million is the carrying amount of the land and building. Then I'll compare it with the fair value of the land and building. So
Okay.
that gives me a surplus of 12 million.
Yeah. I think where the confusion came in was perhaps we are thinking that we are computing for both of them differently. Yeah,
No, we are
not
not.
as a whole. Yeah, okay. Yeah.
We are not. So the only impact that separation is only when you are computing depreciation. So if you want to even understand it better, you see, when you want to compute the depreciation for that year,
Mm.
it will now be based on the new value, which is now, you will then do 20 minus 8. You now have 12. And the remaining useful life is 30 years. So that means depreciation for that year is 12 over 30. Now you can remove the cost of the land when you want to do depreciation for the year. Okay, so let me leave this one for now. Let me do my journal. So my journal, the first I will need to take care of is the value of the assets. Again, may I ask again, why are we debiting 10 million to asset account?
It's to increase the value.
And she what?
The initial value of the asset, both land and building, was 10 million naira. So when it was revalued at 20 million naira. So we need to increase the cost of the asset in the books to 20 million naira. So in that case, we debit the asset account by 10 million naira.
Thank you very much. The same principle all along. So we debit the asset by 10 million. So after we have dealt with that, the evaluation surplus of 12 million, evaluation surplus of 12 million will be credited. We credit 12 million. So what will make this journal balance is 2 million, which I told you will always be the accumulated debt that we need to cancel out, which is this accumulated depreciation here that we computed here. Needs to be cancelled out. Needs to be cancelled out. So, and that balances my journal. And my depreciation for the year, my subsequent depreciation, I will simply debit depreciation expense to P&L, and I will credit accumulated depreciation, being depreciation charged for the year. Now, let me come back to this excess depreciation here. This note 3. Now, why this note 3 is coming up is because we were told that is the company's policy to make transfer to retained earnings in respect of excess depreciation. What that means is that we are going to be transferring a portion of our revaluation surplus to retained earnings every year. And that portion of our revaluation surplus that we are transferring to retained earnings, we call it excess depreciation. And we only do that if it is the company's policy to do that. And that's because IAS 16 says that you can do that. That's why this company can have an accounting policy that will say, okay, do that. So IAS 16 allows that instead of waiting till the end of the life of the assets before you earn your revaluation surplus. You see, this revaluation surplus we compute. Remember that it goes to OCI. And from OCI, it goes to equity. And it's there forever to be there. Okay, and the reason why we said it should go to OCI is because we said this asset or this income or this surplus is an unrealized income. That is why we say don't take it to P&L, take it to OCI. But from OCI, we take it to equity as reserve, and it's there forever. So at what point are we going to earn it? At what point does it become an actual income? So usually we wait till the end of the life of the asset or till when we sell the asset before we say, okay, now we can earn it. Then they will transfer it to retained earnings directly. It doesn't go to P&L again. We take it to retained earnings. So there's a lot of argument around that's a porous accounting, but there's really nothing we can do. So IAS 16 has an alternative that instead of waiting for so long, that you can be earning this revaluation surplus by a process called excess depreciation. Be earning it every year, be transferring that revaluation surplus to retained earnings every year gradually. So they use excess depreciation, and this excess depreciation, they took advantage of the fact that whenever we revalue an asset, depreciation will change. And in fact, depreciation will increase because the asset value goes up, right? So they now say that excess depreciation, use it to earn your evaluation surplus. So it's a principle you need to learn, right? So from this particular question now, the old depreciation was actually 8,000 divided by 40, 200. That was the annual depreciation. But when we revalued the asset, it was now 12,000 divided by 30. So 400 per annum. So there's an increase of 200. That we call excess depreciation. So we are saying with this excess depreciation, be transferring 200 debit revaluation surplus and credit retained earnings every year with 200. So that before the end of the life of the assets, you'll have finished earning the revaluation surplus. So that's the principle of transferring revaluation surplus or transferring to retained earnings in respect of excess depreciation. But the thing is this, this principle I just taught you, you will not find it in your exam. If I want to speak from experience, right, I can have not asked it at your level, okay? But what I'm teaching you here is everything you need to know around PPE. All these questions that we are solving here, there won't be anything new that you will not be able to solve. So that's why you are finding it in my practice question here. So, and again, if they want you to do it, they must tell you this is the same way I've put this statement must be exactly the same way they will tell you. That is the company's policy to transfer to retain earnings in respect of excess depreciation. If they don't tell you that, don't even touch anything around the principle I've just explained now. Don't go near it. But here it was stated, and which is why we are comparing the old depreciation under the old cost with the new depreciation under the new value, giving us an excess depreciation of 200, which we are going to be using to transfer from evaluation surplus to retained earnings. So in this question now, look at how the P&L looks like. The depreciation for the year is 400. The revaluation surplus for the year is 12,000. Okay. Like this is the 400 I'm talking about. The 400 depreciation for the year. This is the valuation surplus that goes to OCI. In my statement of changes in equity, what shows there is the surplus and retained earnings. So my revaluation surplus for the year, from this OCI, it comes to equity. All items that go to OCI are transferred to statement of changes in equity. And we are transferring excess depreciation, this one that I just explained, that 200 that we are taking away. So we'll take it away from surplus, we'll add it to retained earnings. So that's done through the equity statement. So, and these are the value of our assets at the end of the year. Okay, so for me, it can never get more complex than this. So for that reason, I would want you to do question 12. It's very similar to, I know the solution is there, but you are adults. I want you to practice it. Then before you compare your solution with the solution I have here, do question 12 and question 13 as your practice. Now, let's solve question 14. It says, an asset that originally cost 16,000 had an accumulated depreciation of 8,000 was disposed of during the year for 5,000 naira cash required. Explain how the disposal should be accounted for in the financial statements. So whenever there is disposal, all you need to do is to calculate profit or loss on disposal. And this is done by comparing the carrying amount with the sales proceeds. In this case, the carrying amount is simply costs minus accumulated depreciation. The cost of the asset is 16,000. The accumulated depreciation is 8,000. That means the carrying amount is 8,000. The sales proceed is 5,000. In this case, sales proceed is lower. So we're going to have a loss on disposal of 3,000. And this will be recognized to PL. So questions on disposal are usually straightforward. Now, question 15. Okay, I'm not going to do this. I'm going to solve questions like this when I start teaching you publish. When we start solving publish. So I'm not, you can leave, but if you want to try it, you can try it, but I'm not doing it now. The solution is there for you, but I'm not solving it now. There are some things that would help you there. And there's this past questions here. You should be able to do this at the moment. You should be able to do this. I think you should try your hands on this yourself as practice. I have the solution here for you also.
What number is that?
Is under past correction parts. You see the part I wrote past corrections. The part I wrote past corrections. So you really help yourself if you solve it. So there are some questions there, and there's this one on disposal also. This question was very tricky. I really want you to look at this also and see if you'll be able to figure out how they calculate this. So these are practice questions that will greatly help you. So, I mean, you just now, I'm done with this topic. So I'll be moving to another topic. That will be next week, Saturday, Sunday. And don't forget, we are also going to be meeting on Thursday again. So some of you missed the class last week, Thursday. And it's based on our plan. This Thursday is not just happening. And I think it's just this Thursday's classes is just for 4 Thursdays. Just for me to quickly teach you areas I feel that our time will not be sufficient to cover what we have left. That's why I'm bringing up, so that I don't want a scenario where we'll have some topics that we'll not be able to cover or that will not start rushing, because I don't want to do that. I want you to be well prepared before the end of April, that the remaining weeks we know we have covered the syllabus, we'll just be revising everything and go and pass easily. So, and there are some questions within the notes that you should look at. There are some past questions I put in between. So it's a complete package note for you that you have to read. And remember that I'm here to attend to any of your confusion like that. So I'm done for today. So I can take questions now before we leave. Latif, you first.
Thank you, sir.
Yes.
The last question you just treated now on which you resorted to a loss on disposal.
Okay.
If I'm correct, sir, I think I heard you said the loss on disposal should be debited to POL.
That's correct.
Okay, I want to ask, since is it same as if there is a profit that goes to OCI?
No, it will go to P&L too.
POL too.
Yes, as an income.
I said it sometimes, maybe previous class. Now you said it. I was not correct.
Evaluation that
Okay. If I said you were not correct, now you are correct. It goes to P&L.
Thank you, sir. Thank you, sir.
You're welcome. Any other question?
Yes, sir.
Yeah, Oliver.
Yeah, I just want to add, I think it's a general thing, and it has been a source of concern to me. You know, when we compute, when we are preparing the income statement, and we decide to add depreciation to it, if the depreciation is, take for example, 15 million naira, the effect of that depreciation that has reduced that profit for that year with 15,000 naira, and invariably it will reduce the equity. Now, to make it balance, we'll go to the balance sheet and also reduce the value, the cost of the asset by that 15 million naira. Now, that 15 million is somewhere within the organization. That is my confusion. Because
Is
the
it
depreciation actually is not an outflow. It's just to account for the investment that was made in the past, or anyway, like we said, allocating the economic resources over the useful life of that asset. But the thing is that the 50 million is still within the organization. How do we account for it?
okay? So it's just the same thing, right? So if I get you right, the 15 million, which is the depreciation, is just, I mean, if let's say the asset was 60 million and it's supposed to use 4 years,
Yeah,
so rationally, spread the cost of that asset over 4 years,
over
15
4 years. Yeah,
million
yeah,
every year. So, and that's what depreciation does for you. So every year you are taking 15 million to P&L.
yeah.
So I'm not getting the point of your question exactly. That's how do you account for what again? You have accounted for it already.
You know that there was no outflow like other expenses. There was an outflow.
No, no, okay. So again, there was not that you won't say there was not an outflow. There was an outflow, right? And the outflow here was the acquisition of the assets that did not go through P&L. But rather, when we bought the assets, we debited assets straight and we credited bank. So we put it in assets simply because this is a cost that will generate benefit for us for many years. So accrual concepts will not allow us put that kind of expense to P&L in 1 year alone. We
Yeah,
want you to spread it
spread it.
over I mean, that's the principle of accrual.
Yeah,
And that is just similar to rent. When you pay rent for 3 years. You will not put the entire rent of 3 years in P&L. You put the rent of year one of that year alone in P&L. The remaining 2 years, you pay it as prepayment.
repayment. Yeah, yeah.
It's the same thing. It's the same. So that's what depreciation is to asset too. That
Okay,
okay, put everything. Just that asset has complete guidance on how you should, because there's a lot of things that happens to asset along the way, unlike rent that is very straightforward. So it's the same concept.
okay, sir. Thank you very much, sir.
Yeah, and along the line, you will learn that most of the items in P&L are not outflow. Most of those expenses are not actually cash. They are just, you have things like impairments, you have things like allowance for receivables, and a lot of other items you have in your P&L that are not necessarily cash movement. You have provisions, you have bad debts, and a lot more like that.
All right. Thank you very much, sir.
Yeah, good question anyways. No, so I guess we can um have a great night. So be preparing against the competition that is happening at the end of March.